Is France about to fall apart? For decades, France was treated as a constant. Not perfect, not always efficient, but stable. One of Europe's core powers, a pillar of the Eurozone. Too big to fail, and too important to question. But that assumption is now under strain. France is facing rising debt, political paralysis, social unrest, and weakening investor confidence, all at the same time. And what makes this moment dangerous isn't any single crisis. It's the fact that all of them are converging. Today we're going to look at why France is becoming Europe's new problem, why markets are starting to pay attention, and why this matters far beyond France itself. France's debt problem is no longer theoretical. For decades, France has operated under a simple assumption: the state would always be able to borrow. This wasn't recklessness. It was a rational response to the environment. Interest rates across Europe were historically low. The euro eliminated currency risk, and the European Central Bank stood quietly in the background, compressing spreads and absorbing shocks. Under those conditions, debt didn't feel dangerous. It felt manageable. That perception is now breaking down. France's public debt has climbed steadily for years and now sits above 110% of GDP, placing it among the most indebted major economies in the developed world. But raw numbers don't tell the full story. What matters is structure. France is running persistent primary deficits, meaning it borrows even before paying interest. This isn't crisis borrowing. This is baseline policy. Even in years of economic growth, spending consistently exceeds revenue. That means debt is not stabilizing, it's compounding. When interest rates were near zero, France could refinance enormous amounts of debt with little pain. That era is over. As bonds mature, they must be rolled over at much higher yields. This has three immediate consequences. Debt servicing costs rise automatically, without any new spending. Budget flexibility shrinks as interest crowds out policy choices. Markets begin to focus on sustainability, not just size. France doesn't need a spike in yields to feel pressure. Even gradual increases strain a system built on cheap money. And unlike smaller countries, France's refinancing needs are massive. It must issue hundreds of billions of euros in new debt every year just to stay in place. As long as investors treat French bonds as near risk-free, this system holds. But confidence is not binary. It erodes. Spreads widen quietly at first. Risk premiums creep in. Demand becomes more selective. That's when debt stops being theoretical. It becomes a constraint. And once debt becomes a constraint, politics become far more difficult. Political paralysis and the limits of governance. France's debt problem cannot be solved technocratically. It is deeply political. The French state is expected to do more than almost any other in Europe. It guarantees pensions, it cushions unemployment, it regulates prices, it intervenes in strategic industries. These expectations are not marginal. They are central to the French social contract. Reform is always possible, until it isn't. Every French government promises reform, and every French government discovers the same limit. Structural reforms, pensions, labor laws, spending restraint, provoke immediate resistance, not just opposition parties, but unions, civil servants, the street. Mass protests are not a sign of instability in France. They are part of the system. What's new is that the fiscal margin to absorb them is gone. In the past, governments could buy time, delay cuts, increase borrowing, rely on growth. That space has narrowed dramatically, a crisis of governability. France is not facing institutional collapse. It is facing something more subtle, a system that cannot cut spending without unrest, raise taxes without backlash, or grow fast enough to offset debt. This creates paralysis. Policy becomes reactive rather than strategic. Budgets become exercises in avoidance. Long-term planning disappears. From a market perspective, this is dangerous because it suggests that no matter who governs, outcomes remain constrained. Why markets care about politics? Investors don't demand perfection, they demand predictability. France's current political environment offers very little of it. Fragmented parliaments make decisive action difficult. Presidential authority is weaker than it appears. Every reform is temporary and reversible. This increases perceived risk, not dramatically, but persistently. And persistent risk is exactly what raises borrowing costs over time. Here is the core danger. Higher debt limits, political options. Political paralysis undermines confidence. Lower confidence raises borrowing costs. Higher borrowing costs worsen debt. This is not a crisis loop. It's a slow erosion loop, and those are often the hardest to stop. Why France is a European problem, not a French one? France is not a peripheral economy. That distinction matters. Most past Eurozone crises were contained because they originated on the edges: Greece, Portugal, even Italy to some extent. France sits at the center. It is the second largest economy in the Eurozone, a founding member of the European project, and one half of the Franco-German axis that underpins European governance. When France weakens, the shock does not travel outward, it spreads inward. French government bonds are treated as core European assets. They are widely held by European banks, used as collateral in financial markets, embedded in pension and insurance portfolios. A meaningful repricing of French risk would immediately affect balance sheets across the continent. This is why France has long benefited from a unique assumption, that it is too central to fail. Markets have priced French debt not as risky, but as indispensable. That assumption is now being tested. Europe's stability relies on a delicate balance. Germany provides fiscal discipline and industrial strength. France provides political leadership and institutional cohesion. That balance is under strain. Germany is experiencing slower growth and structural challenges of its own. France is struggling with debt and governability. If both pillars weaken simultaneously, Europe loses its anchor. There is no obvious replacement. Southern Europe cannot absorb that role. Northern Europe lacks political weight. This is why France's drift is so dangerous. It exposes a leadership vacuum at the core of the Eurozone. A French crisis would not look like Greece. There would be no emergency summits or immediate bailouts. Instead, contagion would move through. Gradually widening bond spreads, higher funding costs for banks, reduced cross-border lending. This kind of slow contagion is harder to stop and easier to underestimate. By the time it becomes visible, it is already embedded. The ECB's shrinking safety net. In every major European crisis of the past 15 years, one institution ultimately restored calm: the European Central Bank. When markets panicked, the ECB stepped in. It promised unlimited support. It purchased sovereign bonds. It compressed spreads artificially. This created a powerful belief that Eurozone sovereign debt was always backstopped. That belief is now weaker. The ECB faces limits it did not face in past crises. Inflation has returned, forcing tighter policy. Political tolerance for aggressive bond buying has diminished. Legal and institutional constraints remain unresolved. The ECB can still act, but it cannot act without consequences. Every intervention now risks reigniting inflation. Political backlash from creditor countries, legal challenges. This makes support slower, more conditional, and less credible. Higher rates reveal structural weakness. When rates were near zero, inefficiency was invisible. Governments could borrow indefinitely without immediate cost. Now, higher rates force differentiation. Markets are beginning to ask which countries can adjust, which ones can govern effectively, which ones are structurally constrained. France does not score well on these metrics, not because it lacks capacity, but because it lacks political flexibility. The most important shift is psychological. For years, investors believed the ECB would not allow spreads to widen significantly. Core countries were effectively risk-free. That belief anchored the system. Today, It is no longer absolute. France may not be abandoned, but it is no longer unquestioned. And once guarantees become conditional, markets reprice. France is not collapsing, but it is moving from pillar to pressure point. At the same time that Europe faces slower growth, higher rates, geopolitical fragmentation. This combination leaves little room for error. What could actually break? If France were to face serious stress, it would not begin with a dramatic announcement. There would be no sudden default, no emergency summit overnight. European crises rarely start that way. They begin with pricing. The earliest warning would appear in sovereign bond spreads. French government bonds would slowly begin to trade at a wider premium relative to German bunds. At first, the move would look technical. A few basis points. Slightly weaker auction demand, higher volatility at the long end of the curve, but spreads matter because they encode confidence. Wider spreads mean investors are demanding compensation for political and fiscal uncertainty. Once that process starts, it tends to feed on itself. Higher yields raise debt servicing costs. Higher costs worsen deficit projections. Worsening projections justify higher yields. This is how erosion becomes acceleration. Bank balance sheets and credit tightening. French and European banks are deeply intertwined with sovereign debt. They hold it directly. They use it as collateral. They price loans against it. A repricing of French bonds would immediately affect bank balance sheets, not catastrophically, but incrementally. That incremental stress leads to tighter lending standards, reduced credit availability, slower economic activity. This is where financial stress becomes real for households and businesses. As growth slows, fiscal projections deteriorate further. The state is forced to choose: support the economy or defend fiscal credibility. Both options carry costs. And because France's political system struggles with trade-offs, decision-making slows precisely when speed matters most. Why this moment feels different? France has faced stress before. So has Europe. What makes this moment different is context. Every traditional stabilizer is weaker. In previous crises, interest rates were falling. Inflation was low. Central banks had unlimited credibility. Today, rates are already high. Inflation remains a constraint. The ECB cannot flood markets with liquidity without risking credibility. This removes the most powerful shock absorber Europe has relied on. Politics are more fragmented. European cohesion has weakened. Domestic politics across the continent are polarized. Consensus is harder to build. Reforms are slower and more reversible. France is not unique in this, but its size makes the impact systemic. There is no political appetite for another grand European rescue. That matters. Markets often assume they will have time to react. But structural stress doesn't announce itself. It accumulates. France does not need a single bad year to trigger problems. It only needs several mediocre ones, under higher financing costs. That combination quietly drains resilience. France's greatest asset has always been predictability. That is what allowed markets to overlook inefficiency, debt, and political gridlock. Predictability is now fading. And when predictability fades, risk must be repriced. France is not about to fall apart, but it is no longer behaving like a stabilizer. It is becoming a source of uncertainty in a system that already has too much of it. In Europe, uncertainty at the core is far more dangerous than crisis at the periphery, because when a pillar weakens, even gradually, the entire structure begins to adjust around it. And those adjustments rarely happen smoothly.